When we go through a set of accounts for the client, one of the areas that causes the most confusion is the director's loan account. The common questions we get asked are, what is it? Can I have one? And if I do have one, what's the tax impact? So, what is a director's loan account? At its simplest, it's a record of all the transactions between you, as a director, and the company itself. The limited company is a separate legal entity to you, and its bank account is separate to yours. When you set up the business, you probably had to put a bit of money in to get it going. That's treated as a loan from you, the director, to the company. As the company goes forward, there are transactions on this loan where, for example, you might buy some things on behalf of the company. For example, if you're out and about and use cash to pay for a parking ticket or a taxi, perhaps use your own credit card for some purchases. In these instances, you either use your money to pay for things to the company, therefore the company owes money to you, the director. Therefore it's credited to your director's loan account. The flip side is there are times when the company pays for things for you. Perhaps you use the company bank card to pay for a personal meal. And the main examples are when the company transfers money from its bank account to yours, and that money isn't yet already declared as a salary or a dividend. It's just a cash transfer. In a small business, it's pretty common. You're the owner and manager of the business, and transferring money to and from your own bank account is relatively common. The key thing is that it's all part of the director's loan, and it must be accounted for as such. What we find is that when clients first come to us, they may see a figure on a director's loan account at the year end and not know what it is. However, when they see the individual transactions one by one throughout the year, it usually does make sense. It's just understanding the concept of the loan. Well, yes, you are. However, you have to be aware of the rules over that loan account. In particular, you need to understand the rules when the director owes money to the company. It's fine for the company to owe you money, but generally you shouldn't just be taking cash out of the business without it being accounted for properly as a salary or a dividend or in the director's loan. Well, if your director's loan account's overdrawn, i.e. you owe money to the company, there may be a tax impact. HMRC doesn't want you to just take money out of the company, call it a loan, and neither you nor your company pay tax on it. If you are taking money out of the company, ultimately it should be a dividend or a salary which has a tax impact. Therefore, HMRC has a few rules on overdrawn directors' loans. The first rule is on corporation tax. If you owe money to the company at the accounting year end, the company should pay corporation tax at a rate of 32.5% on the balance of that loan. The exception is that if the loan is repaid within 9 months of year end, you don't have to pay the tax. As an example, if your year end is 31st December and you owe your company £10,000, there's a tax charge of £3,250 unless you repay the money by the following 30th September. Not entirely coincidentally, 30th September is also the deadline date for filing your accounts and tax for the year. The reason for this is to stop you running off and not paying any tax. The good news is that when you do repay the loan, HMRC will refund the tax to the company. However, there may well be a time lag, or you may pay the tax in 1 year's tax turn, but you don't get it back to the year later in the next one. But the overall point is it's a way of HMRC stopping you running off without paying any tax. They're happy to pay it back when you put the loan back to zero. The other tax impact is on your personal tax. If the loan's more than £10,000, there's actually a tax benefit in kind on you personally. This is because you've had a loan without paying any interest. HMRC assume you've avoided paying interest and they want some tax on that benefit. They have their own rate for this. The rate's currently 2.5%. So on a £10,000 loan, they'd assume you've got out to pay an interest of 2.5%, i.e. £250, and they'll charge you personal tax on that at your personal tax rate. Is there anything else to consider? Well, it's worth being aware that if the company closes, any overdrawn loan needs to be repaid by the director. The director does remain liable for this personally. So that's how a director's loan account works. If you have any queries, please do get in touch.